All right, welcome back, guys, to We Talk Money. My name's Chris Dunn. I'm here with Travis and Nikki, and we've got a doozy this week. A little bit of climbing prices, and the big question is Putin to blame for all this inflation, or is there something more sinister happening? Before we dive into that, Nick, do you want to give a shout out to our sponsor, ycharts?
Yeah, thanks to ycharts for sponsoring the show. ycharts is a platform for getting great visuals for fundamental research. If you're a retail investor or an advisor, it's just a great platform for diving into the details. Check it out. Go to wetalkmoney.com/ycharts and you can get a free trial. That link will also be in the description.
All right, sounds good. So, without further ado, let's jump into the big question of the day, which is inflation, the big story, I guess, of the day. And got a few things we can point out here. First and foremost, the US inflation rate, the official US inflation rate is 8.5%, if you believe that number. The PPI, the producer price index, is now over 11%. Where do we start with that?
Woo, baby. Those are some hot numbers.
Yep.
Those are numbers that frankly are a little surprising to me, even though we've been calling for inflation to run higher than a lot of people expect for what, a year and a half. I mean, we've had some shows dedicated solely to this topic, a year ago or more. So, but nonetheless, the absolute magnitude of the change, is pretty shocking.
Yeah.
And like you said, these are the official figures. We all know that, there are components within the CPI, like for instance, their component for rent inflation is only at 5%. We know given home prices are up 15, 20%, maybe rent is on a little bit of a lag, but certainly we've seen numbers that are way higher than that official 5% number. So
Yep.
CPI says 8.5. The true inflation rate for a lot of households is probably north of 10 or maybe even 15%.
Mm-hmm. Well, I can confirm healthcare costs today. I had a call with my agent, over 10% increase.
Wow.
In health.
Yeah, I mean, food was up over 10%. Meat is way higher than that. Lumber, I posted a tweet a few days ago just showing that, lumber prices are the same as they were last year. And I walked into Home Depot and I looked at the cost of lumber, and it's double from where it was last year, even with the same lumber futures prices. So that means that the cost of transportation, freight, fuel, and labor, all that stuff is way higher and actually caused those prices to double. And I thought, I was asking Nikki, I was like, do you think that's, just corporate greed, as Elizabeth Warren would lead us to believe? And I guess that's not actually reflected in the data, right? Their margins aren't growing that crazy.
Yeah, that's right. And, if there's any good news, I guess there was some slowing in a couple of categories that have been hot, like used car prices maybe finally starting to roll over a little bit.
Mhm.
But even there, there's not a whole lot of rollover happening just yet. It's just maybe peaking a little bit. And you've got other categories that are actually catching up. Like services are now starting to heat up, as people shift to services over goods. And so, the there are categories that are taking off while others may be cooling. And, there are some people that believe that we're going to peak out at 8 or 9%, and that by the end of the year, we'll see lower rates of inflation on a year-over-year basis, and maybe the market will stop freaking out. But, what happens if it stabilizes at 6 or 7% and interest rates are still at 3? That's still not a great outcome.
Yeah.
Maybe it's better than 9 or 10, but that's still going to be, I think, a problem for some assets. So yeah, it's not a great outlook. And, frankly, there's still potential for areas to increase in the short run. We've got, like I said, rent is still on a lag, so those prices can still be increasing for a while longer. Energy, fuel, food, we've got a shortage of diesel and jet fuel in certain areas. So the PPI, which is the producer price index, which you mentioned, is up 11.2% year over year as of the figures today. That is the sign of what wholesalers are paying. And so that's not prices that the consumers are paying yet, but that often can lead consumer prices. So with that being at 11% on official figures, that goes to show you that either one, corporate margins are going to get destroyed in some areas, or those price increases are going to get passed on to consumers, which means these 8.5% numbers could be even higher by the summer.
Well, let's take a look at what the White House has to say about that and who they're using as the scapegoat for all of these climbing prices.
So because of the actions we've taken to address the Putin price hike, we are in a better place than we were last month. But we expect March CPI headline inflation to be extraordinarily elevated due to Putin's price hike. And we expect a large difference between core and headline inflation, reflecting the global disruptions in energy and food markets. So core inflation doesn't include energy and food prices. Headline inflation does. And of course, we know that core inflation, energy, the impact of energy, of course, on oil prices, gas prices, we expect that to continue to reflect what we've seen the increases be over the course of this invasion. And just as an example, since President Putin's military buildup accelerated in January, average gas prices are up more than 80 cents. Most of the increase occurred in the month of March, and at times gas prices were more than $1 above pre-invasion level. So that roughly 25% increase in gas prices will drive tomorrow's inflation reading. And certainly it's not a surprise to us, but we certainly think it will be reflected.
Well, what do you guys make of that? Is the Putin price hike to blame for all this inflation, or is there something else going on?
Well, when you look at the actual categories of inflation, obviously energy is one that's up a lot. And certainly, we saw oil prices go from about $90 a barrel just before the invasion to, well over 100.
Mm-hmm.
And so there's no doubt that, what Putin has done with the invasion of Ukraine has had an effect on some energy and ag markets. Fertilizer prices, et cetera, have also gone up since the invasion. But there were problems with inflation well before long before. Yeah.
In fact,
yeah.
Might I point out, looking at inflation, she said pre-invasion January, we were still 7% inflation pre-invasion, basically.
Yeah. The momentum was already going, right? It wasn't like the invasion caused all these prices of food and everything, real estate to go up. The trend was already happening.
No, and listening to her and other members in the administration constantly say Putin's price hike over and over again. I mean, Pelosi said it, a few times. It's like they're trying to definitely get it across and pass the buck and make it clear that this isn't their fault, or at least that's what it feels like they want people to believe. But anybody that's been paying any attention at all saw right through that. And they knew that inflation has been on the rise for a very long time now.
Repeat after me. Putin price hike. Putin price hike. Putin price hike.
Look, it's got a good ring to it. I'm sure they were sitting around a long, big table and they came up with it and they were like, yeah, this sounds good. But the fact of the matter is, and this is why I actually tweeted about this, because I was like, I got a little aggravated about it. Because if you are paying attention to the markets, if you are paying attention to, our economy and economics in general, not at a super detailed level, but just very surface level, you'd be able to see right through that crap. And I don't know.
It has nothing to do with the trillions of dollars that have just recently been created. It has to do with, little Putin's invasion. I thought this was kind of an interesting chart that shows how inflation really started to heat up about a year ago. And it was only recently that, this is where Putin's actions started to have some effect, right? But again, this proves that it's not just the Putin price hike that's the problem.
Yeah.
Now, one interesting thing about the inflation print that we got is the core inflation, which is less energy and food, which is stupid because who isn't buying energy and food? But the market actually kind of rallied after the inflation data came out. And I noticed the market basically, as I was watching it unfold, it seemed like the market was happy that the core inflation number hadn't really changed that much. But really, I don't know how much weight I can put on that, because energy and food is so important to the everyday American that it's kind of silly to me to be focusing on that number. But I mean, it's a positive, and any positive we can get right now it's good. But I still think this is troublesome.
So where are we headed, Trav?
It's a great question. I still think that markets are vulnerable to the environment that we're in, which looks a lot like stagflation, potentially. We do have, like I said last week, a good starting point. It's a very low unemployment backdrop that we have. Consumer balance sheets relatively healthy, bank balance sheets relatively healthy, all the credit metrics relatively healthy so far. But, you have this, if high prices continue and you've got inflation that's relatively sticky at high rates, then that is absolutely going to affect a consumer, and that could eventually lead to what a lot of people think could be at least a shallow, if not maybe a worse recession. So
Mhm.
I'm not 100% sure we're going to get a recession, but I think there's a decent likelihood. And I said last week, I think there's probably a logical 20% pullback that could happen in equities and US equities this year, just based on, the environment that we're in with rates going higher. Fed will probably hike rates. We saw Canadian rates get hiked 50 basis points. The market's pricing multiple meetings where the Fed's going to hike 50 basis points. So look, I mean, we're headed for, higher inflation, higher interest rates, and that tends to, not be a great thing for the overall economy. So I think there's a lot of potential pressure out there. I also mentioned corporate margin pressure. So corporate earnings, if those come under pressure this year, then it's going to be a real headwind for markets. So yeah, as I think about markets, there's a lot of headwind there. It doesn't mean that the world's coming to an end and we're going to end up in some great financial crisis, but I think it's just a challenging period that we're facing until some of the supply chain issues get worked out, until maybe the energy markets start to have some extra supply come online and things like that.
Well said. We've got a ton of questions today, so I think we should just go ahead and jump into those. What do you guys think?
Let's do it.
All right. So the first question is from Ryan. He was asking, will Bitcoin ever stop behaving like a risk asset? That's a good question, and I think the short answer is probably not. One thing I want to just kind of mention is the fact that right now Bitcoin is very much correlated with the S&P and Nasdaq. I mean, just stocks in general. They're moving almost in lockstep, right? Like you can see the volatility on a percentage basis is higher in Bitcoin compared to the S&P and Nasdaq, but when you have a market like we're in right now, where there's elevated levels of fear, there's uncertainty, there's not just consistent capital flow, like we're not in a strong bull market like we were last year. Bitcoin tends to follow stocks a lot closer. I use the analogy that the DJ in the party is Bitcoin. So like altcoins are the partiers at the rave. And when the DJ turns the music off, if Bitcoin's not going up, most altcoins aren't going to go up. But there's a step above that, which is the fire marshal that really determines if the party is legally allowed to keep going. And unfortunately, I wish that wasn't the case, but when stocks sell off or when there's a panic, Bitcoin usually follows. And I am waiting for the day that ceases to be true, but at least for now, that's what we've seen. So I think it's healthier when we see Bitcoin take on a life of its own. But for anybody that's either investing or trading Bitcoin and crypto, like you can't ignore equities markets right now.
I think that Bitcoin's volatility, meaning like when you look at the drawdowns over the past decade, it does seem like the drawdowns are becoming less substantial, and we're seeing lower percentage drawdowns as time goes on, and that's as mass adoption comes online, and maybe the volatility has actually come in a little bit since the beginning of time of Bitcoin. But I think that it's still, even with that, so volatile that it's going to take a lot to make Bitcoin not a risk asset or not perform like a risk asset. So that's just my opinion. I think that it's going to be in the cards for a while, if not forever.
Yeah. Tribe, any thoughts?
No, yeah, I think you pretty much covered it. I would love to actually see a pretty big dip on Bitcoin, because like I've said before, I think it actually is a great asset for an inflationary environment, because it is a scarce asset. And, on a longer term basis, I think it can be a just a fantastic asset to own with the backdrop of inflation in the overall economy. So, yeah, I mean, I would love to be able to get it on a deep pullback. If it gets down to 20K range or so. I mean, I'm going in heavy.
Yeah, yeah, that I agree, man. I mean, I'm just really waiting patiently to get out of this damn range. We basically had 30K support, 65K resistance for over a year now, and I think when we get outside of this range, that move, whichever direction it is going to be very explosive. And if we are blessed with lower prices, that's exciting. But also, if we buck the trend and we get back up above the moving averages and the bull trend continues from here, that's also fine because we can buy breakouts and dips and, basically bull market type setups. So, all right. Next question is Raz. Do you ever trade on gut feelings or do you always use data driven approaches?
Ooh, good
Nick,
question.
you want to start?
Yeah. So there's actually a book called Trading from Your Gut, and I read it a while ago, and it talks about this. And there is when you get more experience in the markets, there is a gut feeling sensation that kind of comes to you at certain times when you see certain types of price action or certain types of setups, and you kind of get that gut feeling like maybe the sentiment is going in your favor. And I have made decisions based on somewhat of a gut feeling. I use sentiment a lot. Like the Wall Street bet stuff is, a perfect example. I'm using, trends a lot. I'm trying to figure out, what's popular, what's growing in popularity, whatever. And I guess that is a bit data driven if you're kind of doing that. But at the same time, sometimes sentiment is absolutely, you're using your gut a little bit to try to determine um, your take on sentiment at a certain time. So I would say the more experience you get, yes, there is something uh, to trading from your gut, and you kind of can act on it more and more as you see these things over time. But definitely a lot of data, definitely a lot of technicals, price action, things that you see right now, and then obviously fundamentals. So I would say for me, I definitely have used gut feelings before. I don't know. How about you guys?
Yeah, for me, I'm definitely more rules based. Like I try to minimize as much guessing as possible. But I do combine with the technical chart. I will look at things like market sentiment and like the media and like what I think the mass majority of people are thinking and doing.
Right.
And I'm always looking for pain points, right? Like what could cause people to capitulate or what could cause people to have FOMO and make emotionally driven decisions. But a lot of times those are represented on the chart. You can see the pain, you can see the inflection points, you can see the clear trends or the lack of a clear trend in the chart. So for the most part, I'm looking for rules-based setups that I can back test and have a quantifiable edge. But again, that's not perfect either. History doesn't predict the future, but trade setups for me are kind of like fingerprints, right? Like they're not going to be exactly the same, but you can see similar patterns over time.
Yes.
So I used to be, when I was day trading like over 10 years ago, I used to be a lot more mechanical and like very much rules based or semi-automated. Nowadays, I would say if I had to put a percentage on it, it's probably 80% rules based with 20% subjectivity. How about you, Travis?
Yeah, I tend to not let gut drive because, there granted, like Nikki said, there is some pattern matching that you get over time, that you develop over time as an experienced investor. And I do think, some of that will sometimes help you. Maybe pattern matching is slightly different than gut feeling, or maybe it's the same thing. I don't know. But as a fundamental based investor, we have we we have a lot of data, obviously, from balance sheets, income statements, cash flow statements, company press releases, management, conferences. You can even buy things like credit card data, if you have the resources like at a hedge fund, right? So you can get a lot of data points. And you don't want to ignore that, right? But at the same time, there's also gaps in the data, so it is difficult. Like you're always going to have imperfect information, and like you said, also you're trying to project the future. So even with a great data set in front of you about what's going on now, it doesn't tell you necessarily what this company or this industry is going to look like a year or two or three out. So I guess rather than gut feelings, what I try to really rely on is probabilities and assessment of risk and reward. And so looking at a situation with the data I have and saying, okay, what do I think the upside is versus the downside? What do I think the current probabilities of that, that playing out in either direction are? And I'll use that. And so that helps me to deal with that imperfect information and the fact that we could be wrong. So I would say it's more of kind of taking calculated risks using what we have available to us rather than like, oh, it feels like the stock's going up
Yeah.
tomorrow.
Yeah.
That's a really good point. I think that when you're thinking about gut feelings and trading and investing, it's got to be backed by the data, right? And then if you have that plus that experience of something aligning or matching up in a certain way that's making you feel a certain way, like, oh, I think this aligns with what happened a few years ago and blah blah, then I think that's more so what I was talking about is the backdrop is the data. You're never like just making trades saying, "Oh, I have a feeling that this is gonna," yeah. There's always got to be something behind that.
GME as actually a perfect example of
Yeah.
that, where we identified it when it was at $4. The fundamentals, the existing data on the company didn't look particularly great. However, some of the data, if you looked at the balance sheet, it did tell you, if you knew how to read a balance sheet, that, hey, they do have a bit of runway. They're not going bankrupt next week. They've got enough assets and cash flow that they can probably at least survive for a couple more years. And then the short interest was so high. And then we looked at previous situations where, there was a low float or high short interest to that extreme, like with Volkswagen in 2008, when it squeezed, 5x in one morning. And then we looked at that and we said, well, we think GME, despite, how bad the underlying fundamentals look, they've got a runway of liquidity. There's a really high short interest. What if we do see a situation, a squeeze kind of similar to Volkswagen? You're talking about a risk reward there of maybe 5-1. Of course, it ended up being even more than 5-1. But at the time, we thought, maybe this thing could get to $20 a share. And that's a trade you might take if you're looking for that type of setup, right? The 5-1 risk reward is pretty good, depending on the probabilities there, obviously. So that was one where we used kind of a combination of some intuition about what could happen based on history, combined with looking at the fundamentals and saying, well, maybe it's not quite as bad as the market is saying here. And in conjunction with the technicals, that was something that obviously played out in a very favorable direction.
Yeah. So I guess the lesson would be like for anybody that's thinking, hey, data driven or, gut feeling, ask yourself, what is that gut feeling based on? Right? If it's just like guessing or completely subjective with nothing to back it up, do you have an edge?
Right.
Or are you just gambling? Because there is a fine line in the markets between gambling and being reckless and treating it like a business or a job or a profession. All right, let's move on. Next question. Danny was asking, what are your thoughts on the nuclear power market being the next big boom over the next 4 to 10 years? And he said, no pun intended. But yeah, I know you've looked at nuclear quite a bit, Trav. What's your thoughts on it?
I actually love what I'm seeing currently, in the political arena, because nuclear is kind of having a renaissance where politicians are finally talking about it again. They're sort of being forced into it because they're looking at the energy situation and going, well, we do want to transition to renewables and we do want to transition away from dirtier power sources like coal. And yet, renewables can't really get us there quickly enough with the current environment, at least. And so nuclear is one of those where people are finally taking a hard look again and going, well, we can produce a tremendous amount of power with a relatively clean energy source. And, if we can make sure that we contain, all the safety aspects of it, then it actually looks pretty compelling for a lot of countries. And so I'm very bullish on nuclear. I think it should absolutely be a big part of, energy sources going forward. And developed markets pulled back after Fukushima. The Japanese decommissioned a lot of reactors. The Germans did. The U.S. hasn't really been building new reactors. And so what I'm really excited about is some of these newer design reactors, like from NuScale, which is going public via SPAC, and companies like Rolls-Royce, I think, is even talking about this. These smaller modular reactors that could be lower cost, safer, better, shut off mechanisms and things like that. And so I think if done right, and if the governments of the world will actually use their brains, I think nuclear can absolutely be a big part of the solution for tackling climate change and giving us good, solid baseload power that, in conjunction with renewables, works really well as an entire system. So I'm bullish. I hope that we continue to see movement forward, because it actually is a little bit, there is some optimism there, I think.
What's the pushback? Is it just the fear of having another Chernobyl
Yeah, it's
or
that.
Fukushima?
Yeah, so I would say it's 2 major things. Yeah, there's obviously a lot of, not in my backyard sentiment. Like, if someone wants to build a nuclear power plant, a lot of citizens will say, "That's great, but not here." And so there's a lot of pushback based on, some of the safety incidents we've seen in the past, Chernobyl, Fukushima, and I guess you could say 3 Mile Island. But, when you look at the total operating hours of all of the, 400 plus nuclear power plants in operation today, obviously there's very, very few and minimal safety issues. So
Mhm.
if we can make sure that we even, fortify the safety of these reactors even more, then I think, that can help solve that issue. The second big issue that we've seen in markets like the US is that reactors have been incredibly expensive construction projects that have gone over budget. And so the last 2 built in the US, in South Carolina and in Georgia, were kind of disasters in terms of the overall project. They went way over budget. They took way longer than expected, and they became kind of boondoggles. And so there's a problem here, at least in the US, with construction of the larger reactors, and we have to figure out what the problems are there that we can solve. Is it grift? Is it corruption? Is it incompetence? Is it a shortage of workers?
All
And
the above, probably.
yeah, those have to be addressed. So, yeah, I mean, China and India are building a lot of reactors, which is great, but I want to see more reactors being built, hopefully the small modular reactors in developed countries.
Well said. Next question, Nick, I'm gonna kick this one off to you. How do you deal with inflation, especially if you have a lot of cash in the bank? And I've already bought Bitcoin, physical gold, and property.
Well, you did all the right things there. I mean, in an inflationary environment, buying things like Bitcoin, even though, people are arguing that it's not the inflation hedge that we expected, but still, I think that it's a good one to own in the face of inflation. Gold, obviously, huge asset that people buy to hedge against inflation, and real estate, land, things like that as well. So obviously, you are one step ahead here. I think that it's risky to get too aggressive into all of those things, and I think it's important to continue to stay diversified, because obviously, we don't know what's going to happen. Inflation could start to come back down eventually, and we'll see what happens, but you want to be prepared for everything. If you have a lot of cash in the bank, what I tell people is um you have to think about setting aside the cash that you need to live your, life, have your emergency fund, to where you're comfortable, whether that's, 6 months, 12 months. Everybody has kind of a different number there of living expenses that they want in cash. And then anything that you don't need, cash that you don't need, you're going to want to get it invested if you can, because obviously, even being invested in stocks in an inflationary environment, historically that has actually worked quite well. And I think that you want to definitely look at what your goals are and why you're investing and when you're supposed to retire, how much money you need, and think, okay, well, this money in my savings it's just losing money to inflation. I don't need it. Usually we want to try to deploy the cash we don't need into the markets in whatever, asset class that you prefer. So I think that it's better to be invested than to not be invested right now.
And I guess that's also the dilemma or the balance between just passive investing, right? It's like, I've got cash. Do I just throw it in the markets, dollar cost average, or do you try to be more tactical with it, where you go in and you're actually trading, right? You're buying individual stocks or cryptos, and you're basically being more active, looking for alpha doing that. And
Typically with passive investing, if that's your style, you really don't want to have a lot of cash lying around. You want to get that cash working. And the data shows that a lump sum investment over time is probably going to do you better than trying to time the market, right? But with active investing, stock picking, whatever it is, that is definitely something where cash position is a bit more subjective, and it really depends on the opportunities that are in the market right now. So I know personally, and probably Travis as well, we are in our active portfolios. I've been harvesting cash. I've been trying to build up that cash position because there are a lot of charts that are down, falling knives, opportunities as I see them. And B, if we do see the markets roll over, I want to have some cash to be able to take advantage of that. So that's for the active side.
awesome. All right. Next question. Tikita was asking, how relevant is Ramit Sethi's philosophy of preferring renting over buying housing in today's current interest rate environment? And I guess also with housing prices being at record highs, right?
Depends on the location.
Yeah, it depends on a few things. I actually have a pretty strong opinion on this. For anybody that doesn't know, in high school and right after high school, I was actually in the mortgage business, and I worked for some of the largest national home builders in the US. And I've seen thousands and thousands of scenarios of people that couldn't afford houses at all to people that were just buying second homes with cash and all types of different time frames. And so as far as I understand Ramit's argument, it's like, look, the old school belief of like, you have to buy a house and that's a responsible investment. It's not necessarily true for everybody. And I think renting does make sense in a lot of cases. The first thing you want to look at is time frame. Like if you're going to buy a place and you don't know that you're going to own it for at least 5 to 10 years, it's probably not worth buying. The other thing too is looking at the true cost of owning a home versus renting. And if you can try to do like an apples to apples comparison there, because with owning a home, your major costs are, if you have a mortgage, what's the interest rate, property taxes, which could vary greatly depending on where you are, homeowners insurance, maintenance. I think those are kind of the major ones. But if you look at what the true cost is, and that true cost is typically about 5% of the value of the home per year. Again, that can vary by a percentage or two. But if you compare that with what it costs to rent in a certain area, say it's, to own a home that you would really enjoy being in, say it's like $3,000 a month, but you can rent a similar or basically the same home for $2,000. And then you look at the opportunity cost, say I can take that extra $1,000 and invest it somewhere else. Those are kind of the comparisons you want to do. So there's not like a right answer for everybody. It really depends on your time frame. Obviously, can you afford it and how are you going to finance it? And then what are the other options that you have available to you?
Yeah, no, I think that's really well said. The only thing I would add on is, look at the rental yields and see what they are in your existing market. Rental yield being the amount of rent per year that you'd pay over the cost of the home, right? And in some markets, like in really really hot markets like San Francisco, where prices of homes get so far out of whack with incomes, you have this situation where rental yields become really, really low. And so it actually might make sense to rent in those markets because, people are buying houses with capital, not with like, based on income. And so rental yields can get squeezed down really low, meaning, buying a home, the price of the home gets way out of whack relative to incomes. And meanwhile, rent is, on a relative basis, actually reasonable still. So
Yeah.
so in those cases, maybe that is a clue as well to look at your individual market and say, well, what are the rental yields, and what are home prices relative to income levels, medium income levels in this area? And then of course, all the individual factors that Chris mentioned, like your time frame and how much house you can afford and what your lifestyle factors are and things like that. But yeah, I think that those are all clues that can help you figure out if you're going to be financially better off renting versus owning.
Yeah. Nikki, anything else from the financial planner perspective?
No, I mean, you guys hit the nail on the head with that one. And, an example that I'm close to is In the city I live in, living downtown is very expensive to buy. It makes way more sense to rent, in the heart of the city than buy. So I don't feel bad about it. I don't feel guilty about it. A lot of people, it's called rent shaming. A lot of people have rent shamed others and said, you're dumb for not buying a home. That's a waste of money. Rent's throwing away money. And that's just not the case. I don't ascribe to that at all. And I think that it just depends on, like you guys said, the lifestyle you want to live. Do you want to be downtown where it's expensive to live? That may make more sense to rent. Do you want to be in the suburbs? That may make more sense to buy. So I think that it just depends.
Well said. All right. Next question. How do you deal with inflation, especially if you have a lot of cash in the bank? Oh, wait, we
already answered that.
Never mind. Okay, here we go. Daniel's asking, what are your thoughts about leverage tools like futures and ETFs for commodities and Bitcoin? To what extent do they distort the market price of an underlying asset? So for anybody that doesn't know, you have spot markets, right? You have like spot Bitcoin, you have spot, commodities, oil, lumber, stuff like that. Actually, you have spot lumber? No, I guess that's just futures. But you basically can trade the asset, or you can trade a future or another derivative like an ETF. And the question is usually like, well, what's the tail and what's the dog, right? Who's wagging who? And I've seen moments in Bitcoin where I think the futures markets are absolutely playing a massive impact on price. And then there's other times that I'm not so sure. What do you think, Trav, in like traditional commodity markets?
Yeah, I think it really does depend on the individual market. You look at something like, the crude oil market, where they have very deep liquid futures that go out, years, and there are actual producers and those along the value chain that are actively hedging in those futures markets. And so the financial buyers or the financial participants in futures are probably in many cases dwarfed by the actual, producers and consumers of those commodities in the futures markets. And so those work really well because, producers can hedge their production out 2 years, or, various ways of using, those deep liquid futures markets to plan their business. Now, there are other markets where, financial buyers or financial investors probably have some negative impacts. Like uranium, for instance, is kind of an interesting one because uranium, there's now financial buyers in a very thin market for uranium. You've got these new like Sprott physical uranium trusts and Yellow Cake, and they're buying up a lot of the available uranium. And the uranium market's getting very tight. Uranium prices have gone from 25, 30 bucks a pound to over 60 bucks a pound just in, really since the start of the year. So that's a case where these financial buyers are really putting a lot of upward pressure. And now some of the utilities that buy uranium are starting to think about their long-term contracts that they have with uranium producers and figure out, how they're going to price their uranium contracts outside of these markets. And so in this case, I do think you have some, some players in the market that are, not core producers or consumers of the actual commodity that are distorting prices in a way.
Yeah. I think another good example is when the CME futures launched for Bitcoin. That literally created the top of the 2017 bubble. And I think it's just interesting anytime you see, basically spot prices were straight up before this, and this was within a couple of days of the all-time high in 2017. That literally created that top. So do futures markets affect the spot price? Absolutely. To what extent? I think it kind of changes over time.
Yeah, it depends on the individual market and what the participants are doing. Like if you think back to the early 80s, was it late 70s, early 80s? The Hunt brothers tried to corner the silver market.
Yeah.
silver prices went parabolic, and then they sort of got in trouble for that. So yeah, there's funky stuff that can happen in futures markets. And from a morality standpoint, I can't make a total judgment about all of futures markets just because they're so unique. Each one is so unique on its own.
Yeah. And Bitcoin even gets more complex because you have all these like unregulated futures markets that offer some of them really crazy leverage. And, I don't know. I look for extremes in things like lending rates and liquidation events and things like that. But do I make all my trading decisions based on that? No. It's just, it's too complex.
Yeah.
All right.
I will say you do need to be very careful when you're trading, specific futures markets. I know some traders will jump into commodities markets, like, they'll start trading wheat because of what happened in Russia and Ukraine, right? And they know nothing about the actual producers and consumers of wheat that are transacting in the futures market, right? And so,
Yep.
or what we saw with crude, where the front month crude futures contract went negative in April of 2020. And there were some individual investors that actually went bankrupt because, and there was a Wall Street Journal article about it, because they thought they could buy crude at negative oil, negative prices, and they would make money on that. Well, it turned out that you had a specific delivery point, in a very specific location in Oklahoma, where you had to take delivery of the oil, and these individual financial traders could not take delivery. And so, they had nowhere to go with the oil, and they had to end up selling at a loss. So you got to be very careful if you're trading in commodities futures markets. You have to understand who the players are and what the contract specs actually are.
Well said. All right. Matthew, all of you on We Talk Money are bullish on the U.S. stock market. Did we say that? I don't know. It seems that all U.S. is doing is quantitative easing to keep stock market at record highs, and all that does is fuck the average Joe who's working. So I know this is a very common narrative, and let's address the first part. Are we bullish on the stock market?
Well,
I'm certainly not at the current time.
You're probably the most bearish out of all of us right now, for sure.
And I tend to be pretty optimistic over time, but in the near term, I've got about half of my portfolio value hedged with some short futures and short ETFs. And I've said, I think multiple times in the past couple of weeks, I think we're probably looking at a potential for a 20% decline in U.S. stock indices, given the current environment. But that it's obviously that may not happen. That may not play out that way, but that's sort of my view for the short term. So I'd like to see that, because it would give us an opportunity for better inflation beating returns if we did get a pullback in valuations in the overall market. So I am certainly not an all-out bull on U.S. equity markets at the moment.
Nick, are you a bull or a bear?
I'm a long-term bull, but I mean, I've talked about wanting corrections, wanting pullbacks in the market all the time on this show. I like corrections. I like, the blood, because that's an opportunity for me, because I am, long-term bullish on the stock market for the reason that the stock market is you investing in a bunch of companies that provide goods and services. And do I think that these companies are going to continue to grow and provide goods and services and innovate over decades? Yeah, I want to have a piece of that, right? So I'm bullish long term on the stock market, but I absolutely appreciate the bear markets too. And to be honest, sometimes I feel like we haven't seen enough of them lately. I mean, the market has been in a straight line up. And, to address the QE part, the quantitative easing and the Fed stuff, this is a very common narrative that the stock market is up because of QE. And what I think that obviously the Fed has had their hand in pushing people towards risk assets like stocks, because they've had low rates. They've kept rates low for so long, and they've supplied liquidity to, the market. But the Fed doesn't buy stocks, and we are valuing stocks, constantly as investors based on earnings. We're literally looking at earnings and what these companies are producing every single quarter, all the time. And so the market's not dumb. Like, we're in tune with what corporations are doing. If corporate profits decline, the stock market declines with it. You can absolutely compare the data and see that that's what's happening. So what that's telling us is that it's not all, roses, right? Like, when we saw 2020, we saw 2008, we saw corporate profits decline, and the stock market declined with it. So that's going to continue to happen, and we're going to continue to evaluate if the market is under or overvalued and price it accordingly. I think too many people think that the market is just up on fluff and hot air, and forget that there are producing corporations behind the stock market. And so, can it get overheated? Absolutely. But long term, and usually the market, figures that out and reprices along the way. We've seen it happen. But long term, I am I'm investing for retirement. I'm investing for the future. And this has historically been one of the best ways to build wealth. And so I'm going to continue to do it until something completely fundamentally changes.
Here, here.
That's just
No,
my
I
thought.
think that's right. I mean, I don't think the data doesn't suggest that the corporate or stock market valuations have changed all that much because of QE. Now, you could argue, maybe there's been some real effects in things like the mortgage market or in corporate bond spreads and things like that, because the Fed being so active in buying Treasury bonds does have an effect. The Fed buying mortgage-backed securities has an effect, right? So that's why we've probably seen mortgage rates shoot up so fast in the last couple of weeks, because they are pulling back, or they're signaling they're going to pull back from buying mortgage bonds. So yeah, so I think those are the markets that are probably most affected by something like QE. The stock market
Right.
certainly has some spillover effects, but like Nikki said, we don't see outliers in terms of equity valuations. I mean, they're a little high, but they're not at all-time high historic levels. And frankly, like Nikki said, corporate earnings have continued to grow over the past few years. So there's really not a case, I think, to be made that the Fed is really affecting equities that much. And as far as like screwing over the average Joe, that's why, I think a lot of us try to make the pitch that, people should be investing in high yielding assets and in assets that can produce growth over time, stocks being one where you've got a long history of markets going up over time and corporations being innovative, right? So I hope that people will participate in that rather than getting sucked into some scam or getting sucked into holding cash in an inflationary environment where they're just losing purchasing power.
Mhm.
Yep. That's a good segue into our next question, which is from Random Ostrich. He was saying, once you become an accredited investor, what's the best way to use that status to make money instead of being a regular retail investor? Well, the first step is you got to get your accredited investor pin, and you'll get the secret password and the invite to the underground meeting where all the evil accredited investors hang out. Unfortunately, we can't give the password out publicly, but
The password is Elon.
Illuminati.
yeah. No, I mean, I think the most common ways are, if you find yourself in a situation where you're like, hey, I'm accredited now, ask yourself, well, what are my goals? What do I really want to do? Do I want to throw a bunch of money at startups, crypto projects, or what are the rounds that you want to get into? And then you have to find a way to get access to those rounds. So in angel investor clubs are probably a great place to start. That's where I started. That's actually where we met almost 10 years ago.
That's right.
So that's a great place to get connected and learn. I mean, I probably watched, I don't know, 200 or 300 pitches before I made my first angel investment. So yeah, I don't know. What would you add to that?
Yeah, for sure. I mean, when you become an accredited investor, more things open up to you. Potentially, you could invest in startups, you could invest in venture funds, hedge funds, those less regulated vehicles that are typically associated with accredited investors, even real estate deals, limited partnerships, all sorts of things. But, that gives you also a lot of ways to lose money.
Yeah.
So you have to be careful, because you get excited as an accredited investor, like I probably did when I first started investing in startups, and probably invested in some that I shouldn't have.
You didn't make any bad investments, did you?
Yeah, I did for sure. Had some winners too, but yeah, you have to be careful, obviously. But a big broad swath of traditional, or I'm sorry, not traditional, but alternative investments, as they say, opens up to you. But that also opens you up to a lot of potential ways to lose money very quickly and get into very illiquid investments. So you have to be careful. So like Chris said, I highly encourage you to just kind of just test the waters by maybe joining an angel investing group that's in your area or something like that, or starting to. I think there's even venture funds that do training now for angel investors, like First Round Capital does a program, and there are a few others as well. When you get to a really elite wealth level, like when you're above, I think probably above like 20 million or more, maybe 25 million or more, you can actually start to have relationships with some of the larger investment banks and wealth management firms, like Goldman Sachs Asset Management, Morgan Stanley's wealth management division, and they will do a lot of the work for you of getting into unique investments, not only their own funds, but also you could potentially participate in later stage rounds of private tech companies. You could get shown access to deals like commercial real estate deals and things like that that aren't available to even smaller accredited investors. So yeah, the more things open up to you, the richer you get. That's just sadly the way it is in this world.
Yeah, I mean, we've been very vocal about how it's the existing laws are kind of ridiculous, but I don't know. We can only do so much. And one other thing I wanted to say, the other asset class that's not quite as sexy as startups, but I really enjoy is managed futures funds. We talked about this, I think, last show. But basically, it's another great way to hedge. So when the markets are volatile or in bear markets, they typically do well. Like year to date, I'm up over 30% on those. So that's just great. I mean, I love having that as a piece of the pie. And unfortunately, a lot of those are, minimums of 100K to $1 million to invest, and you usually have to be accredited. So yeah, I mean, I to add on to just that question, I would just say for anybody watching this that's like, I'm not an accredited investor yet, do everything you can to get there, because the old saying of like the first million is the hardest to make. I believe that to be true. It was like my first million took 25 years to get there, and then it accelerated after that, right? So that's the power of compounding.
Yeah, and there are new ways now to get the accredited investor status. Like there's some, I believe, some series exams that you could take and pass, and actually get your accredited investor status from that, and a few professional certifications as well. So they're slowly trying to expand it, but it's still something.
Still has a way to go.
Yeah.
Yep. Cool. Magic Murph was asking, what's in your crypto portfolio and what level are you accumulating? Okay.
Oh, wow.
That's a good one. I need to run the numbers. I'll just tell you like kind of my largest positions. Number one, Bitcoin. That's usually always the case. Number 2 and 3 are some of the Ethereum or an Ethereum competitor. And that usually makes up 80 to 90% of my portfolio. And alts are, I trade alts to accumulate more Bitcoin and a few other projects. But let me pull up a tweet that I said. Actually, I'll just say it. 99% of cryptos are probably not going to survive more than 5 years. And I invest and trade accordingly, right? Like my goal is to when I'm actively trading alts, is to either accumulate more fiat profits, dollar profits, or more Bitcoin that I can stash away or, have for different time periods. But I think it's just smart to go in thinking that, hey, it's probably not the smartest thing to just accumulate a ton of shit coins. It just creates more work. Most of them are going to fail. And, if stuff is tracking Bitcoin and or Ethereum anyway, if it's not going to outpace the growth of the majors over the course of several years, why would you want to underperform by being overly allocated to some of these shit coins? So
it sounds like too, based on your comments recently and in the community, that you're not super heavy as far as your allocations because of the range that Bitcoin's been in. And,
Oh, yeah.
you've obviously you would take more trades and be sized more aggressively if we were in a more clear direction.
Yeah.
That goes to the second part of the question. What level are you accumulating
Yeah.
Bitcoin?
So I'll pull this up real quick. So basically, I've been trading Bitcoin since 2013, but I got really heavy in the second half of 2020, anticipating another bull market, and then took a lot of profit in last spring. So just about a year ago. And then you can see since then, price is basically flat from a year ago, and it's been very choppy. There's a big range. So I've had some trades, but my position sizing has been smaller, and I have not been like aggressively accumulating Bitcoin. I'm waiting for one of two things to happen. Either a washout for an extended bear market where we get the blessing of lower prices. Some people look at that as a curse. I look at it as a blessing. Or continued trend, strong trend continuation that's confirmed by the price action, which we had a fake out, right? We actually had a all-time high kind of tweezer top fake out here in November of 2021. And since then, I've been very, very conservative with position sizing and with the frequency of my trades. So I'm waiting. I have a lot of cash on the sidelines, and yeah, just waiting for this price action to get out of this damn range.
That's how I feel about stocks right now.
Yeah. All right. Next question. Javid was asking, if sanctions prove to be a powerful weapon, how does that affect the government's response to crypto, since it could undermine that power? So basically right now, with the Russia situation, Putin and some other places are exploring cryptos as a way to get outside of the SWIFT system. And I think the question is, that's on a lot of people's minds is, well, is that going to make the US and the UK and other Western countries aggressive towards crypto? That's the $200 trillion question. I don't know if I have the answer, but if I had to answer just yes or no, I would say no. I don't think that's going to happen.
I think I
we're too
agree.
far along. Yeah.
Yeah. At least in the US. Who knows what the hell Europe will do, but and other countries. But
Yeah.
I don't think that the US is going to mess with it.
The EU's already been trying to do stupid stuff against proof of work. And look, governments are going to flirt with this, right? And this is why we have to be active about pushing back. But I just think, hey, Bitcoin's unstoppable. They can't stop it. I don't care what government or political party or leader has an agenda anti-Bitcoin. Like, can they cut off the on-ramps to the traditional banking system? Yes. Can they threaten you with prison time or worse? Sure. But can they stop Bitcoin? Hell no.
Yeah, I don't think the genie's going back in the bottle on this one. The crypto actually has a pretty powerful lobby now, and also a lot of government officials have left government and joined the private sector on the crypto side.
Yep.
Got a lot of companies, celebrities. I mean, there's a lot of involvement now from a lot of different angles. I think that would make it difficult and very unpopular for politicians to try to really shut down crypto or shut down major off ramps. Could it happen? Sure. In certain countries, maybe. And like you said, countries are definitely going to try to push CBDCs and take more control over their own money supply through their own digital currencies.
Yep.
But, I don't think that, I don't see a situation where that, would be necessarily bad for the existing crypto markets at the current time.
I agree. We did a couple of surveys this week that I wanted to pull up. The first one was Nikki. She says, what hurts worse as a trader? Number one, taking a chance on a trade and it doesn't work. So basically you have a trade and it loses, or not being in a trade that you wanted to be in and it ends up working.
I was proud.
69% of people said not being in a trade that works.
That was the right answer.
Yeah. Why is that the right
That
answer?
was the right answer, because when you get into a trade, you should be planning your trade and accepting the risk on the trade. And if you're doing that, then there's really nothing to be super upset about. It's definitely more gut-wrenching when you've done the work, you have the setup, and you know it's an A setup, and you accept the risk, and you don't take the trade, and it ends up working. That's what sucks. So I was actually quite happy to see the results of that little poll that I did.
Yeah, I agree. I mean, unless you take a trade that you shouldn't have in the first place and it loses and you regret it. But that's also bad if it wins, because then you're just reinforcing a bad behavior that over the long run is actually going to cost you money.
Right.
All right. My survey was, when do you like to buy the most? Either on breakouts, dips, depths of bear market, or I have no damn clue.
Wow, 23% have no damn clue.
Almost a quarter
That's
of people,
a lot.
I guess, don't really have a plan for when and why and where they buy.
They need to join the community.
That's why we have the community and the boot camps. Yeah.
Depths of the bear market, though, that's the right answer.
That is the right answer. I wonder how many of those people actually have the cojones to buy in the depth of a bear market, because when you're in a bear market, there's a lot of uncertainty, right? It's like, there's always that looming question, like, is price going to come back? And I find myself questioning that in every market cycle too. I'm like, there's a possibility price doesn't come back. And some Bitcoin maxis would be like, how dare you say that? You know, price only goes up. But, you know, as an investor, I put that hat on and I'm like, you have to entertain that possibility.
I guess it's a lot harder in crypto because, like in stocks, when we have things just plummet, we're like, oh my gosh, look at this valuation. You know, like things, we can have things to back it up and have more confidence buying in the panic because of valuation, right? But with crypto, it's like, I don't know, 10,000, 20,000. Like, what's the right price? I don't know.
It's totally
It's totally
subjective.
different.
Yeah.
So it's quite interesting.
Yeah. I mean, the value of Bitcoin is, I mean, we've talked about this so many times, like there's so many mental models you can use, but at the end of the day, it's that the belief that people have in Bitcoin that drives the price. And with the way the world's headed, I think the bull narrative is there, but in the short term, there's a lot of chaos that can happen. And I think that's why we're seeing so much volatility and choppiness.
And that's why the technicals work so well on crypto.
Yeah, well, they do when it's trading with conviction, but when you're in a choppy range, I mean, you get traps, you get pop stop runs, you get all kind of just really nasty price action, which as a trader, that's why you got to lighten the load and be more selective and just know that, you know, you could take a series of strikes, right? You could have small loss, small loss, small loss, bang, grand slam, right?
That's
Not always.
That's a really good point because right now in stocks, we weren't quite sure if we were going back into a trader's market because traders disappeared for a while there after, you know, all the growth stocks took a hit. And, you know, we had some good hits on some swings and then we saw some things really working and some short squeezes start to happen. And we thought, oh, you know, I was thinking personally, maybe we are shifting back into the trader's market. And of course, we see the market pull back, and you're always having to, you know, evaluate and if it doesn't work right away, that's okay. Like I think people forget you can always get back in when price action, you know, comes back and gives you even more confirmation or gives you higher probabilities due to the way things are you know, say you're retesting some key resistance levels multiple times. It's like the probabilities go up. So I think that anybody that's trading right now, this is kind of a rough time because we've had some good times recently, and now we're kind of having to reset again. And I say you have to just keep your eye on the prize and don't be afraid to get back in if the charts come back and set up again because you don't know when that, you know, market is officially going to be back in that momentum is going to be back.
The worst thing you could do is just get disinterested in the markets or walk away and get distracted. You've got to have a routine that keeps you engaged. And I just popped something up on the screen for you guys watching the video. If you go to wetalkmoney.com/community, you can see our Discord channel, our weekly classes that we do, all that fun stuff. Just figured I'd throw that up before we wrap up. Anything else you guys want to talk about before we go?
Well, I was just going to mention too, we also have our boot camps opening up again soon.
It's true.
Yeah, running those, and those are a great way to like really dive in deep and learn, you know, stock fundamentals or, you know, trading setups and all sorts of things about crypto, stocks, you name it.
Yeah, it's 8 weeks of probably what 40 to 80 hours worth of video and then an equal amount of class time.
Yeah,
pretty intense stuff, but yeah, thanks for watching, guys. If you have any questions, go to wetalkmoney.com. You can submit a question for the show there or reach out if we can be of any help. And thanks to Nikki and Trav for being here and contributing all their knowledge. And yeah, we'll see you guys next time.
Yeah.
Take care.